Hi, everyone, and welcome to the week ahead. I'm Tony Nash. Today, we're joined by Brent Johnson and Tracy Shuchart. We may be joined by Albert Marco at some time, but we're just going to focus on Brent and Tracy right now. Guys, thanks so much for taking the time to join us. I really appreciate it. CI Futures is our subscription platform for global markets and economics. We forecast hundreds of assets across currencies, commodities, equity indices, and economics. We have new forecasts for currencies, commodities, and equity indices every Monday morning. We do new economics forecasts for 50 countries once a month. Within CI Futures, we show you our error rates. So every forecast, every month, we give you the 1 and 3 month error rates for our previous forecasts. We also show you the top correlations and allow you to download charts and data. CI Futures is available for $50 a month, $75 a month, or $99 a month. You can find out more or get a demo on completeintel.com. Thank you. We've got a few key themes we're going to cover today. First is the Fed's second quarter danger zone. There's a lot setting up for Q2, and Brent's going to talk us through that. Then we're going to get into Capex and C&I commercial and industrial loan growth. And then finally, we're going to talk about those Russian barrels that are coming off the market this month. And Tracy will talk us through the impact there. Okay. Guys, thanks a lot for taking the time. Brent, when I asked you what you want to talk about, you really want to talk about this kind of Q2, potentially Q3, these issues that we may see in markets in that time. Can you help me understand, or help us understand, what are you looking for there? Because there's a lot going on, of course, and you can talk us through a number of items. But I have a tweet from Daniel Lacalle, who's joined us a few times, talking about the ECB under pressure for faster rate hikes. We're seeing similar stuff in the U.S., but markets keep going up. So what are you thinking?
Yeah. Well, I think there's a couple of very, poignant and competing narratives fighting each other right now. And they've been fighting each other for a while. And I'll explain why I think they're fighting each other. But I'll also explain a little bit about why I think Q2 and Q3 have the potential. Again, there's no guarantee, we're all speculating here, but has the potential for one of these narratives to kind of come to the fore, or something to change dramatically in Q2 or Q3. So I think the first narrative is that has been around for a year now. So we're almost, still not yet, but very close to now, the 1 year anniversary from the first rate hike. And I think a lot of people forget that it hasn't even been a year yet since they started raising rates. And typically when you raise rates, it doesn't have an immediate impact in the economy. Sometimes it takes 9 months, 12 months, 18 months for those rate hikes to actually kind of work their way through the economy and have the full effect of them show up. So we're not even to a year yet. But in another 3 or 4 months, we'll be, in the 12 to 18 month range, and when they typically start to show up. Now, in the meantime, we continue to have inflationary prints that are stickier than some people have expected. Again, part of the reason markets have been pretty favorable for the last 2, 3, 4 months is the expectation that rate hikes would slow and potentially even reverse, and maybe we even get to a cutting cycle. And as a result, the markets are front running that. But now in the last couple of weeks, and so at the beginning of the year, we had a big rush up in bond prices as rate hike expectations came down, and stock prices and commodity prices. But for the last months, let's call it since either the last week of January, first week of February, I've kind of turned it violently sideways. We've gone up and down and up and down and up and down, but kind of just treaded water. And actually, if you look back 2 years, we're kind of where we were a couple of years ago. We've gone up and we've gone down, but we're kind of where we were 2 years ago. And so, but because of the stickiness, the relative stickiness of the inflationary prints, this idea that rate hikes are now going to go the other way is starting to get, a little queasy. And maybe they're going to have to go back to 50. Maybe they're going to have to go longer. Maybe they're going to have to go higher for longer. And so now markets are trying to figure this all out. And so the reason I think once we get into Q2 and Q3, it gets very important is for 2 reasons. One if things stay sticky in the meantime, the Fed may have to either keep hiking or continue to message higher for longer. And then if at the same time, all of the previous interest rate hikes start to show up in the economy, and then at that point, we are going to be in the heart of the year over year inflationary prints. And those will most likely show negative. Even if inflation is still high, it's probably, I think, was it last June or last July, we had the 9% print in inflation. So even if this year it comes in at 7%, it's going to show a -2 year over year. And so that puts the Fed in the position, okay, inflation is starting to come down, we're making progress, but you still have high inflation. So does that mean that they stop or do they start? And it's going to be at the same time where all the previous rate hikes are going to be showing up in the economy, right?
So when Powell, sorry, go ahead.
Yeah, no, but my point is we're getting to the point where a lot of the decisions that have already been made would naturally start showing up in the economy, but we're not quite there yet. And in the meantime, the Fed is in a tough spot as to whether to continue rate hikes or to slow them down, because we are seeing some disinflationary pressures, right? And so they're in a tough spot right now.
Yeah, so when Powell spoke, I think it was in the last meeting, he talked about the lag effects of Fed policy. And it was almost in a defensive way saying, hey, it may not look like much is going on, but there's serious lag effects to our policies, and you better watch out. And I think that's when they rolled out the 25s, when they started rolling out the 25s. And so I'm not sure that at this point I see an end to 25s. I mean, Sam Ryan's on the show has talked several times about how it's at least 25s until midsummer, right?
I think so. Yeah.
And I think we're starting to get some nervousness from the pace of inflation in Europe. And I think that's kind of bleeding over here a little bit, because people are seeing the prints in Europe and saying, gosh, is that coming our way too? The ECB is going to have to hike faster. And so, what's that going to do to, say, the dollar and other things as well? And when we have a relatively strong dollar, the impact that's having on commodity prices, it mutes them, right? So
right. Well, so now you just touched on something else that's very important to understand. Okay, so if Europe is pressured to keep hiking, or at least hiking more than expected, that has the potential, again, no guarantee, not everything trades on rates, but it has the potential for the dollar to fall more. That's why the dollar has fallen for the last 4 months, is the pace of rate hike expectations. So if we already have sticky inflationary data, and then the dollar starts to fall in price again, that can actually provide a tailwind for the inflation that the Fed is trying to counteract, right? So again, it puts them in this tough spot. And the other part that you just mentioned is, and this is where it gets tricky as well, is if you look over the last year, but not just last year, if you look over the last 10 years, oil is about where it was a year ago and about where it was 10 years ago. Natural gas is below where it was a year ago, huge drop off, and about where it was 10 years ago. Corn is about where it was 10 years ago. Wheat's about where it was. Copper, you look at all these commodities, they've actually come down quite a bit from a year ago. But what has remained the stickiest is the wage data, wage inflation, or those costs. And I know we're going to talk about that at some point as well. And so that could be more to do with a structural issue that the Fed has really no control over, right? If people have, they're retiring, they're moving out of the workplace, and they're just not coming back, and so you have a demographic issue where there's just not enough supply of labor, it pushes up the price of labor. That is something the Fed could influence, but not as easily as they can influence asset prices. And so again, you get into this situation where I think everybody knows the further down the road we go, the higher the likelihood we have some kind of an event, right? Whether that's a crash or just a volatility explosion or whatever it is. I think everybody knows that something down the road is not going to be good. Now, whether that's 6 days or 6 months or 6 years from now, that's the debate. But I think we all know that there's the potential for this great event. And, again, if we get into Q2 or Q3 and it hasn't happened yet, and you have this confluence of all these events that I'm talking about, And in the meantime, asset prices have gone higher, or at least held where they're at. You have the potential for this, bursting of this, bubble, for lack of a better word.
Right. So go ahead, Tracy. Sorry.
I had a question. So we're seeing that 2-year and 5-year inflation expectations start to rise again. So what do you make of that, and what does that mean for the Fed and the Fed's decision, right? Because
well, I think this gets to everything we've just been talking. It puts them in a tough spot because they have very clearly started to slow. Right now, they have said we're going to maintain and we're not cutting, and we could be higher for longer. But there's no question that they have, at least for the last 4 months, have not been hiking at the same pace that they were last summer. But the worst thing for the Fed is if they're back at 25 basis points now, or if they were to indicate that or maybe we'll have one more hike of 25 and then maybe we'll be done. But then you get inflation starting to rise again. I mean, that's horrible. That's the worst possible thing for the Fed. And it throws their whole it throws their whole reputation. It's not that their reputation is great anyway, right? But after getting, the last couple of years so wrong, for their credibility to be challenged again is a really tough thing. And I've mentioned this before. You cannot underestimate, in my opinion, you cannot underestimate the influence of getting it wrong would have on Powell's legacy. And I think he's been very clear that he doesn't mind having asset prices lower. In fact, I think he wants asset prices lower. And so while I completely understand the argument for they're going to have to cut, I don't think he can personally take the risk of stopping hikes too soon, because the risk of stopping too soon is extremely high for him personally.
I want to go back to your wages point for a minute. So, when we have a company like Walmart make their minimum wage $15, and then that cascades through the economy because it doesn't hit everyone immediately, there's a lag to that hitting the economy too, right? So what you talk about and it doesn't just hit people making below $15. Those people who are making $15 are like, wait, I was making 15, now everyone's making 15. So it cascades up a little bit, right? And it cascades out. And so that takes months to hit also, right? So that just happened in January. Right. So we're going to see this impact on wages at least for the next couple of months, right? Or do you think it happens?
I think so. And again, when we get to an event, let's call it either a credit event or a contraction in the money supply or a bursting of an asset, whatever, when we get to an event and things turn the other way quickly, then that stuff can change quickly. But until that happens, there is a tailwind for them to get worse, or for the structural wage inflations, for them to work themselves through the economy. And the other thing that I think many people forget this is that, and I got to be careful how I say this because I don't want to confuse people, and I don't want people to think that I'm just absolutely bullish, because I'm not. I do think we're going to have one of these credit events, and I do think disinflation is more likely than runaway inflation. But until we get that event, there is an inflationary tailwind, not just because of the things we've already talked about, but because of the higher rates. And what I mean by that is, as long as the banking system doesn't contract and there's not a deflationary crash, the higher rates are actually pumping more money into the economy, right? It wasn't that long ago, you had to go out 10 years on the yield curve to get anywhere close to 4% return on your money. Now you can put your money in the closest thing to cash and get 4% on your money. So the people who have the money in their accounts are getting more money pushed into it because the Treasury has to pay higher rates. And that's just now kind of, again, that's, if the federal funds rate has been slowly ticking up, but now, some of those, rates that people receive are just now resetting higher, or have just started to reset higher in the last couple of months. And the further we go along without this quote unquote event, more money gets put into their account in the form of interest payments. And that's a tailwind, because now you have more money to spend. And
And
so,
Go ahead, sorry.
right? No, my point, the point that I just want to make is that I believe that we're going to have this event, and I think we're going to have it sometime this year. But until we have it, there's a tailwind. So it's almost like it's going to be speeding up into the wall.
So
Right.
how much of that tailwind, Brent, is, people have put on pretty easy trades for the past few years. And how much of that tailwind is people who have a little extra money in their account, who just want to make that one last trade, right?
I think there's a lot of that. And that's typically why it ends badly, right?
Mhm.
If you think about an exponential curve, it goes up and up and up and up and up and up, and then it crashes. And it's because those last people are trying to get that last little trade in. And the other thing that I'll say is, I think this is really important to understand. And we were talking about it a little bit before. So it's repetitive for us, but for the people on the show, it was last summer, Q3 of last year, where the yield curve inverted. Actually, it inverted just slightly in Q2 of last year, but then the real inversion took place in Q3. And at the end of Q3, we had a point where the stocks were at their lowest level in 2 years. The VIX was at its highest level in 2 years. The dollar was at its highest level in 2 years. And I actually, at that point, I even sent out a tweet that said that probably due for the dollar to pull back. And I took off all my equity hedges, and I actually bought equity calls. And people are like, why the hell are you doing this? And I said, because the yield curve is inverted. And they said, what? That means there's going to be a recession. And I said, yeah, but usually that takes 12 to 24 months to show up. And historically, in that 12 to 24 months between the time the inversion happens and the recession arrives, you typically get a run in equities. And so that it kind of goes counter to everybody thinks higher rates, you don't want to own equities. That's bad for growth. But in actuality, it ends up that way. But in the short term, it's actually typically historically good for stocks. And so, I to be honest, and I'll fully admit it, like that trade worked, but I sold it way too soon. I chickened out because I see this wall coming, right? But, had I held it for this last 6 months, it would have been a monster trade. But I sold it after like 1 month because I chickened out on it, to be quite honest. But that's something that's very important to understand. And here's the other thing, and I'll give you some historical context, and it'll explain two things. It'll explain the magnitude of the run that can happen, and it'll also explain the horrendous result that can come afterwards. And that is it from 1926 to 1929. Let's call it from 1920 to 1926, you had seen stock prices run very high. It was like the roaring 20s, right? And then in 1926, the yield curve inverted. And it stayed inverted until 1929. And in that time period, from 1926 to 1929, the long-term US Treasury fell 30%. So if you were invested in bonds during that yield curve inversion, you lost a lot of money, just like last year, right? But guess what stocks did over that 3-year period? They more than doubled. They went up 150% with the yield curve inverted for 3 years. And now we all know what came after 1929, right? After that last trade, to your point, pushing that last trade into the market, then you had the huge fall. Yeah. We could very easily have something like that again. Now, I personally am not in the camp that we're going to go into another Great Depression. I don't think it's going to play out that way, but I can't rule it out. But it's all of these cross currents. It's because I understand the tailwinds, and it's because I see this massive wall that we're racing towards, that I think right now is the hardest environment I've ever seen to be an investor, or at least to be an investor with conviction. I think it's very hard. The good news, and I would encourage people to think about this, the good news is that in the last 10 years, if you didn't have conviction, it was very hard to sit on the sidelines because you got no return in your account. Interest rates were zero. But you can now sit on the sidelines, wait for clarity, and get paid 4 to 5%. That's not a horrible idea, right? So anyway, that's kind of my soapbox moment.
Oh, these are all great points, Brent. And I guess it's just time for people to be careful. I don't think you're saying the sky is falling today. I think you're saying just don't hold the bag.
Yeah, and I'm not saying you can't make money. I've used this analogy with clients a few times to explain what I mean, because I've said, well, couldn't stocks run another 15 or 20%? And I say, yeah, absolutely they can. I said it's like when Evil Knievel jumps over the fountains at Caesar's palace, and then his son does the same thing. Well, Evil Knievel crashed and broke every bone in his body. Robbie Knievel, landed the jump and was fine. Got a lot, huge glory. And so, but they did the same jump. So whether you land well or land poorly, you took the same amount of risk. So I'm not saying you can't make money over the next 6 months by being in the stock market. I'm just saying you're taking a lot of risk in order to do it. And if you don't want to take that level of risk, you can sit in T-bills and get 4.5%. That's not a horrible sideshow, right?
Right. Yeah. And just for people who aren't familiar with Brent, I don't know who isn't, but he's not a total doomer, right? You're not this, perma bear. And
I try not to be.
I just don't want people to think you're kind of a perma bear coming on and trying to spread kind of the perma bear gospel. It's, you do change your views as markets change. And, this is just a kind of a sober view on kind of where we are.
Yeah, I own a lot of equities for my clients right now. We have participated in the run, but we have not been levered on it. And I'm not all in on that trade, but we own stocks in our portfolio. We think it's time to be careful. We think you should have some hedges. We think you should have some cash, but we're not sitting in our bunker just waiting for the sky to fall.
Great. Okay, that's all good to know. Time to be very, very sober about things. You mentioned loans and interest rates, and Brent, you were mentioning some things about commercial and industrial loans, and Tracy, you've talked about Capex, especially in energy, pretty regularly. And Brent, you were saying something about the C&I loans have risen over the past year, even as interest rates have gone up. Can you talk us through that?
Yeah, so this is kind of another part of the narrative, the combating narratives that I think people forget is, the reality. Many people didn't think the Fed would ever be able to raise rates, but not only did they raise once, they've been raising them for a year now. They've raised them aggressively, and the markets have not collapsed, to many people's chagrin. And many people said, well, as soon as the Fed starts raising rates, they're no longer going to be increasing the money supply. Okay, that's fair, but and I know a lot of people think that the central banks just print money and flood the market with money, but where the real printing of money comes from, where the real creation of money comes from is when banks loan money. When you go down to your bank and you take out a loan, and let's say you take out $1 million loan, they don't take somebody else's $1 million and give it to you. They create it out of thin air. That's fractional $1 million. It's right. That's a new $1 million that's now in the economy that wasn't there before. And so, a year ago, loans had been coming down aggressively since COVID. So they've been ramping up. I want to say like in 2020, it was around $2.4 trillion. And then after COVID, they did all these PPP loans and it spiked to like $3 trillion. And then since the PPP loans, it's just been steadily every month, down. But I think it was last March or April, it stopped going down and it actually started to tick up. And now it's been going up for a year. And so it's up about 10 or 15% from the bottom. So that's the creation of new money. And despite the fact that the higher rates have not yet caused anybody to go bankrupt, it's starting to happen. I know BlackRock had this happen to them with one of their funds recently. But despite the raising rates, you haven't seen mass bankruptcies yet. And not only that, you see new loans being taken out. So the existing supply of money is still there because we're not getting the big credit contraction, and new money is being created through new loans. And so again, you have this tailwind that's actually speeding things up towards this wall that I believe we're heading towards. So again, it's kind of part of the same thing we've already been talking about, but it's just another facet of it.
No, it's good. Some economist is going to write in and say that's not technically new money, but it is new money, right? Because
Well,
it's circulating in the system and people are using it.
yeah.
So,
Right.
okay, so what drives that? I mean, it seems to me that when you have interest rates kind of steady for a long period of time, people tend to say, well, I can always put that investment off until tomorrow. But then when you see interest rates start to rise, people wake up and go, whoa, wait a minute, I better make that investment before it rises even more. Is that what's happening?
So I'm actually not an expert on this, and I don't know for sure, but here's my theory on it. And so I'm sure we'll get a lot of people that tell me I'm wrong, but this is kind of how I think about it. You know, I've been on record in the past as saying low rates are deflationary for the reason you just explained. If the market condition is so bad that the Federal Reserve has to, has to resort to these extraordinary measures and pull interest rates to zero, is that really an environment where you want to go borrow $1 million? Maybe, but that's kind of scary, right? And so I kind of feel like low rates keep people from borrowing money and keep people, and it's borne out if you look at these reports. That's typically what's happened. But if you are in an industry and you are competitive in that industry and you want to remain in that industry and you have not taken out that loan, but then let's pretend, as an example, you own a shoe store in Dallas, right? And you compete with a couple of the malls and a couple of the other independent sellers. And a year ago, they took out a loan and bought more inventory and increased the size of their showroom or whatever it is. And you didn't. But now we're a year ahead, market's holding up, everybody's going to those new stores to buy shoes. They're not coming into your store as much. And in order for you to compete with them, you need to build a bigger showroom, you need to buy more, whatever it is. Well, now your loan costs 2 or 3% more than it did a year ago. And so now your question is, if I want to remain in this business and the crash doesn't come in the next 2 months, if I wait another 3 or 4 months, our rate's going to be 2% higher.
Yep.
And so they're kind of behind the 8 ball. And so what I think happens is, as interest rates start to rise, if you need the money, you will borrow it.
Yep.
And we get into this
a
thing
friend doing a restaurant franchise who's going through who went through that exact process in terms of deciding when to take out money. It was extremely low. Interest rates started to rise, and he felt urgency to get his loan locked in and got it locked in because of the change of rate, right? And the perception of the future change of rate made him, so those expectations played.
I did the same thing. I bought a place in Puerto Rico last summer, and I think our mortgage is around 5%. It had been like 3% if I'd have done it 3 years ago. We did it at 5, and now I think they're at 6 or 7. But that was part of my calculation. It's possible that rates will go higher. Now, it's also possible that they'll crash to 3, in which case I refinance and I'll be fine. But the point is as money gets more expensive, if you're going to stay in business, you need money. And so we get into this other theoretical thing where money is a gift and good. I say money is a gift and good. And a gift and good is something that, typically when something rises in price, the demand falls. But not with a gift and good. With a gift and good is as demand rises, price rises, or as price rises, demand rises as well. And it's because you just need it. It's like this drug you just have to have. And as interest rates start to rise, you will pay more and more and more. And people say, well, if it gets too high, they won't pay. And I always say, okay, maybe, but if high interest rates keep people from borrowing, then explain to me why Visa is in business and why loan sharks exist. They exist because even though they have rates, people need money and they will borrow at high rates. And so I think that's kind of what we've seen as well. Again, I think this is all going to end, but all of this contributes to where we see markets at today.
Yep, I think you're exactly right. Tracy, can we change this focus of Capex to energy? Because it's pretty well known, and you've talked about it several times, that energy hasn't invested in the upstream since 2014 or something, right? So do you think that rising interest rates, and there is some change in the tone of ESG speak in the US over the past couple months, do you think the rising interest rates may push some of these companies to start investing in the upstream, or is that just completely ridiculous?
I think that, I mean, I'd be hesitant to say, yeah, I think people are going to, or oil companies are going to jump on board with this, because we still have this rhetoric in the West saying that we're phasing you out in 10 years. We want you gone. And so oil companies are therefore, they just don't want to spend the money, and it doesn't really matter at what rate it is at. And it's good news. We've seen Vanguard leave the Zero Alliance, and we've kind of seen a lot of these banks kind of push back, and a lot of these investment funds kind of push back on this ESG narrative. But I just don't think that's quite enough until we see governments really focused more on ESG. And even though, say, for example, and it seems hypocritical, we've seen Germany, for example, their coal usage skyrocketed in 2022, that as they're closing nuclear plants. Meanwhile, they're pushing this green initiative. The problem is that since natural gas prices have come back down to prices that they were pre-summer of 2022, I think that that they've become very complacent, and this is how natural gas prices will stay, and natural gas prices are going to stay low. But that's, looking at the European economy, on the other hand, is, the damage has already been done. We're already seeing kind of some deindustrialization in Germany.
Absolutely.
You have BASF leaving forever. You have a lot of smelters across the whole of EU that are just not going to come back online when they had to. In fact, a lot of them started shutting down in fall of 2021 before the Ukraine invasion. And the thing is, you can't just reignite those blast furnaces. It takes a lot of money. You have to keep them running 24 hours, 24/7. And, we're just not seeing that industry come back, unfortunately. And the ironic thing is, if we go back to BASF, in particular, they're moving to China, who is buying cheap Russian oil and gas.
Yep.
Right?
Crazy, right?
So, because it's cheaper to do business over there in general. But so, I think at this point, and we've also, I wanted to add, we're also seeing companies, oil and gas companies in the UK sort of, because of their windfall taxes, that's affecting business as well. And so they have decided to either leave the UK altogether, right? We just had Suncor in Canada sell all their assets in their joint venture to BP. We've heard from Shell, Equinor, and BP all said that whatever we wanted to invest in UK, we're not going to do that anymore. So because of these windfall taxes. And so, I think that we're running up against a lot of problems here that are more government oriented, bureaucratic oriented than are, say, central bank oriented or rates oriented.
We have had some state governments in the US push back on ESG, right? And we did have a bill in Congress that passed that was pushing back on ESG, but there's a veto coming or something on that bill. Is that right?
Yeah.
So governments are getting involved to some level.
Absolutely. We have 20 states right now, basically, that are pushing back on the ESG narrative, saying we do not want our pension funds investing based on ESG. We want our state pension funds investing on, what we think is going to make us money.
What's going to make money? Right. Imagine that, right?
Nice. That would be a good focus.
So there are 20 states involved in that. Texas is one of them. Florida is one of them. So that's still kind of going through the court system at this point. And as far as this new the amazing thing is this ESG legislation that will likely get vetoed was that it passed the House and the Senate.
Yep.
Yeah.
That's huge.
Yeah,
That's huge news. That's a huge shift, right? So, and not by a small margin. I mean, relatively speaking, when we're talking about other pieces of legislation. So, that the narrative is shifting in the U.S. So, I think it's too early to say where this is going to go, but it is definitely something worth keeping your eye on.
Great. Okay. All right. That's good. Let's talk about the Russian supply cuts. going into this month. They're going in, this month. Tracy, what does that mean? Can you kind of put that in perspective of their overall supplies?
Yeah, I think in general, what people expected was when they announced this, and they announced this a month ago, that, oil prices were going to skyrocket. But I don't think they were doing that to raise oil prices and stick it to the West, right? And raise oil prices that they wanted to see. What they wanted to do is narrow that spread between Urals and ESPO, which are their two main crude grades, with respect to Brent, because that's how it's the prices quoted. European oil prices are quoted in Brent minus whatever the spread is, right? And so what they wanted to do is they wanted, after the price caps and all of the sanctions, et cetera, they wanted to, we saw those prices, those front month prices in those particular grades fall dramatically. And so I think what they want to do is narrow the spread, and it worked. And so really that's what I think that whole thing or that whole decision was geared for. And then you also have to understand is Russia includes condensates within that, which is those lighter oils, within their total oil production, whereas the rest of the world does not. And so we don't really know exactly where that 500K is coming from. Are they those like naphtha, or is it pure crude? And where that really remains, just so people kind of understand the market a little bit.
I think Tracy, and I might be wrong, but you're the expert here. But I think another contributing reason that they cut production is, to your point, in order to get that spread closer, right? Because the spread, the discount was pretty significant, right? And a month ago, I think they announced these, the production cuts. And a month ago, they announced that tax revenues were falling, and as a result, they were going to have a budget deficit this year. But what I didn't see until kind of a couple of weeks ago was that as a result of the production cuts and as a result of the tax revenues falling so severely in Russia, that they are changing the way taxes are calculated on Russian producers.
Exactly.
And they are doing, and this is not going to be in favor of the Russian producers, right? They're going to increase the taxes on the Russian producers to try to alleviate that budget deficit. So I don't know that they were 100% correlated, but I don't think that they're unrelated, right? In other words, if they're going to tax Russian producers at a higher rate, and it is taxed on the difference of the spread between the West and Europe, they not only want to get the spread closer, or the price higher, the discounted price higher, and then tax at a higher rate. So it's kind of a double whammy on the producers.
It's a double whammy on the producers, but it's income for the government.
Right. No, exactly.
Exactly. You know what I mean? And this is the same thing I was kind of talking about earlier on another podcast. Is what is interesting is that, Russia's suddenly buying this huge fleet of vessels, right? So they own the vessels, and they're now insuring themselves. So the government's making money no matter what. They're just paying themselves. So Russia's not really losing money on this, even with the price cap and with that spread being lower. Now, if you look at, and moving on to that, there was just an independent study done that assessed the international sanctions impact on Russian oil imports. And I think it was researchers from Columbia University, University of California, and the International Institute of Finance. And what they discovered is really that Russian crude oil is really selling for $74 right now, when all is said and done, which is well above the $60 price cap.
Wow.
And all we hear from mainstream media is they're losing money. But in reality, and I read this paper, and I'll post it on Twitter later if anybody wants to read this paper. It's very interesting, and it's very well done. But so Russia is, and they essentially are selling oil above the price cap. There's nobody to stop. There's no way to stop them.
Yeah.
To be honest.
Yeah, sanctions are great, but if there's no enforcement mechanism, they don't mean anything. And the Russians know that. Russia, Iran, China, they all know how to circumvent.
Iran's the most sanctioned country in the entire world as far as the oil industry is concerned, and they're still making money, and they're still
of course they are.
able to export. So,
Of course,
Just shows you how powerful oil is.
right?
exactly.
Right?
So
Yeah.
Tracy, who does the 500,000 cut hurt? Is it hurting Asia more, or does it hurt markets generally globally just because it's crude oil?
Well, I think again, it's very hard to decipher because we don't know what 100% is being cut. Is it all oil, or is it just these light condensates? And so I think in general, I don't think it hurts anybody in particular, because I mean, if the markets were that worried about it, oil would be at $100 right now, easy, right? And so I don't think markets are that worried about it. I also think markets are kind of, let's wait and see what this actually is. And that brings me to a second point, is that right now what's happening is that we're having a bifurcated market, right? So the oil market, which did its thing for 30 years, 30 years, very nicely. Trade routes were settled. We were in this groove. Now we have literally a gray market. I mean, we always had a black market and a gray market, but I mean, now, we're talking 10,000 barrels a day in the gray market, not, a few million barrels from wherever else. So we're talking about, a large
Sorry, you said 10,000 barrels?
10 million, sorry.
10 million, okay.
Which is approximately Russia's
That's a lot.
production. So, and this is the gray market right now, right? Because they have their own vessels, again, their own insurance, they're doing ship-to-ship transfers, they're doing all this shady stuff, offline to kind of, mitigate and get around Western sanctions in any way possible. And so we really are seeing this market where it's going to be harder and harder to, if you're a barrel counter, it's going to be harder and harder to actually track these barrels, because that gray market has exploded in volume.
Interesting. You tweeted a story about some Russian crude being seized in Albania. So that's one of the, I guess, paths to circumvent. Can you talk us through that and why that's important?
Well, I think that it was interesting because, I mean, this is not something that, again, there are offshore ship-to-ship transfers going everywhere, particularly if you look off coast. Spain is a very big hub for Russian ship-to-ship transfers, right? And Greece. I just thought that was interesting because my first thought was 5 minutes later, it's going to be on the black market via the Albanians.
Sure. Yeah. Yeah.
But yeah, I mean, they just happened to get caught, and too bad Albert's not here. He could probably better explain the Albanian.
You know the guys.
It was probably him.
It might have been. Yeah. Okay. So, I mean, I guess the message that I'm getting pretty consistently, and tell me if I'm wrong, these are sanctions put on by Europeans, but through Albania, through Greece, through Spain, and other places, they're circumventing the sanctions. When I say they, I mean people in Europe are circumventing the sanctions that their own governments put on. Have I misread that?
No, I mean, I think that everybody's trying to kind of find a way around the sanctions right now. And you have to remember, this only applies to seaborne crude, seaborne Russian crude. I mean, we still have gas piped into Europe, and we still have oil piped into Europe right now. So it's really only seaborne crude. And
so if it's piped, it's fine.
Yes.
That's amazing. Really amazing.
Yes.
Wow. Okay. Great. Hey guys, let's just take a quick look at what you guys are expecting in the near term. What are you guys looking for, say, for the next week? What's ahead? Tracy, it sounds like energy markets are kind of, sideways for a while.
I think we're kind of stuck in this $70, $80 range right now in WTI. OPEC is very comfortable at $80, $90 range for right now in Brent. And so, I think that as we move closer to, say, high demand season, and we get more clarity on China and what their domestic demand is going to really look like, I think we could definitely see a push to the upside. But for right now, I think markets are very comfortable where they are, and I think OPEC is very satisfied where markets are right now.
Okay, great. That's when events happen, though, right? When everyone's comfortable.
Well, exactly. Well, right, exactly. I mean, you never know what could happen. You had the story this morning from the Wall Street Journal say EU is leaving, and I was like, what? No, they're not. And they retracted the statement.
UAE leaving OPEC and all that stuff. Yeah, crazy. Brent, what are you looking for in the next week or so?
I kind of think we're going to continually have this violently sideways. I think markets are going to go up one day and they're going to go down the next. And I think in general, I don't think we're going to get real clarity in one direction or the other until at least the Fed meeting. Possibly, we do have CPI that comes out a week before the Fed, so that will have a big impact, no doubt, unless it comes in right on the number, in which case, it'll be violently sideways again. But I'm trying to just be nimble right now. I don't have any huge convictions either way right now.
Right.
I kind of have my long-term view while I understand the short-term tailwinds. But I think it's a time to be prudent rather than a time to try to be brave. So, that's kind of a cop-out answer, but that's kind of the truth right now.
No, I think that's a great way to put it. Time to be prudent rather than time to be brave. I love it. So, okay, guys. Hey, thank you so much for your time. I really appreciate it. This is great insights. So I appreciate it. Have a great weekend and have a great week ahead. Thank you.
Thanks, guys.
Thank you, guys.